We've got Ashutosh Khajuria, who's President for Treasury at Federal Bank, joining us on the show from Mumbai. Now, Mr. Khajuria, you've got the inflation trajectory moving pretty much in line with what the market was expecting. So that's really worked as a positive for the fixed income markets. But what do you believe the biggest, the hindrance really to seeing a bond rally is going to be for the fixed income markets?
The markets always discount the future events, and this is what has happened in bond market also. On one side, we saw 10-year benchmark had almost crossed 9%, and from 9 it has already trading now at around 8.18, 8.19. So it is a big rally. Only thing is, inflation number was expected to be below 8%. In fact, in one of my earlier interviews, I had shared with you that we may not see big figure as 8. Right from 9, 11 or so, we may simply see 7 point something or so. So I think even on conservative basis, almost 1 month earlier than these numbers actually came out, market was expecting it to be below 775 or so. And finally it came quite close to what market expectation was at 7.47% or so. I think going forward we may see it coming at around what RBI had been projecting. By March 2012 we may see somewhere around 7% or even sub 7% now. So I think rally has already happened. The answer to your question? Yeah.
Sure, go ahead.
Yeah, I was saying that rally has already happened. We have seen, in longer papers, long bonds and all, the appreciation has been as high as 4 rupees or so.
Right, and Mr. Khajuria, I just wanted to get in your view with regards to the liquidity crunch in the system. Do you believe that what we would need is a CRR cut plus OMOs in tandem in order to address this problem?
Let me clarify one thing. With OMOs and all, liquidity is never infused in the system. Liquidity comes to the system through OMOs only to the extent of the haircut that is kept. Because against a bond of, say, face value 100 rupees, you can raise 95 from Reserve Bank of India. So when OMOs come, these bonds are, excess supply of SLR is mopped up from the systems. So to that extent, banks are not able to raise under repo. So there is not actual injection of liquidity into the system, barring that haircut amount, margin amount of 5% or so. The liquidity would actually be injected through CRR cut. So OMOs, while on one side are a good tool to mop up excess supply of SLR securities, G6, in fact, because we had 2 tranches of 53,400 and 40,000 crores of additional market borrowing. And a major part of it, I think, to the extent of maybe 75% would be mopped up by Reserve Bank of India. I was just going through the numbers. Till December, I think 41,000 odd crores were mopped up by Reserve Bank of India. And I think till yesterday, the amount would have been something like 61,000. And we still have another OMO coming on Friday, and which would be again for 12,000 crores. So I think my original estimate of 600 billion to 800 billion is quite likely. I think we may even breach 800 billion rupees, 80,000 crores or so. I think now the mopping up of securities through OMOs would, not many OMOs are in the offing, I hope, maybe this one, the one which has already been announced, there could be 1 or 2 at best more. So I think the liquidity would actually be injected only through CRR cuts. And I'm quite hopeful that something in this, we are expecting from the Reserve Bank of India to come in the coming policy. It could be maybe 50 basis points cut, because that would be actual infusion of liquidity.
Sure. But you're right, Mr. Khajuria, the fact is that all of you in the banking system are betting pretty much already factored in a 50% cut in CRR on the 24th. The RBI is making a case for a CRR cut not needing to be done, saying that, inflationary pressures continue to persist, that any sort of a cut in CRR will send a wrong message to the market, and that a cut in CRR should be expected only when the interest rate cycle actually begins to turn and to start going down. Now, why do you still believe that you need a CRR cut? You've got OMOs addressing a large part of the challenges that you're facing. Why do you still need a CRR cut?
No, that's what I'm trying to, address. That's what I was trying to discuss with you. Tell you that there is no actual infusion of liquidity through OMOs. Because To that extent, excess supply of SLR reduces from the system. Now, this excess supply of excess SLR holding of banks, helps them in raising funds from Reserve Bank of India under repo. Now, when through OMO, this excess SLR is mopped up by Reserve Bank of India, to that extent, banks can't borrow to that extent. I mean, barring that 5% margin. As regards actual infusion of liquidity is concerned, it would be only through CRR. And RBI has gone on record saying that for them the comfortable level is something like 1% of NDTL to be the shortfall in liquidity. And if you have more than 1 trillion rupees being borrowed from Reserve Bank of India, I think 1% of NDTL is somewhere around 60,000 crores or so, 600 billion or so. So there is a case for CRR cut. This is what I'm trying to highlight. It's true, the transmission of monetary signal would continue to happen if the market is in deficit mode. And 1% of NDTL being deficit in liquidity is enough to take care of transmission of, monetary signals. We are not moving into a surplus zone wherein, call rates and all the base rates and others, would start moving towards south and all. I mean, just by injecting, say, 50,000 crores liquidity into the system. Persistently, I mean, it's no more a frictional thing, that deficit, liquidity deficit has become more like structural, consistently the system is borrowing around 1 trillion rupees or even more than that from Reserve Bank of India.
So, Mr. Khajuria, but assuming that in the credit policy there will be no CRR cut as the RBI goes ahead and pauses rates this time around once again, in light of that, what would you pencil in terms of the range for the yield on the 10-year bond?
I think whether it is CRR cut or repo rate cut, the direction is quite same, because market would, bond dealers would take it very positive. If there is no CRR cut, there could be some upward movement in yield. It could be from maybe 5 basis points to 15 basis points, nothing beyond that. Reason being, if it doesn't happen on 24th January, it's likely to happen very shortly thereafter. And for that, we don't need any review of monetary policy or any, quarterly meeting or mid-quarter meetings or so. CRR cut can be announced any time. It can come, we have seen in the past RBI has been using this monetary tool, not necessarily on the review date or so. They can simply say, maybe on one fine morning, maybe Friday evening or so, that from next day or from next fortnight beginning, CRR would be lower by this much. We necessarily do not need any, review meeting for that.
Right. And lastly, Mr. Khajuria, just a quick word on the rupee. What's the outlook there?
I think going by, that Big Mac model, they say, rupee is overvalued by about 60%. They see it somewhere around, maybe it should be 22 rupees or 23 rupees to a dollar, but that's not the model, which really works in India. But going by your REER model, otherwise, I think it should be in this range from 50 rupees 50 paisa to 51 rupees 50 paisa. There could be, some value buying in Indian assets, rupee assets, both on debt side as well as on equity side. That may really help in, appreciation of rupee. But I think it is going to continue beyond 50 for some time.